Hey, ladies and gents, this is Mike Headley. We are back. Another great episode on the Headley Group Real Estate Show. We got a gentleman who we kind of reached out, and I think he would have been a great fit on our show. He has many talents, been in the real estate industry for a while. He's going to enlighten us with some great insight. It's the first time we had an underwriter on our show. And people in the real estate world knows that underwriters, people you never see, right? They make that final call on your property. Let's give a warm welcome to Mr. David Ball with Coins and Culture. How you doing, brother?
Doing good. Appreciate you. Thanks for having me on. Really appreciate it.
It's a great thing that you want to come on the show. We thought that this would be a great fit for our audience, and a lot of people want to hear and get in the mindset of where you're coming from in terms of underwriting, just mortgage tips, strategies, and also the brother got a great popping Instagram page, so we
appreciate it
and support that.
Appreciate it,
brother. How long have you been in this real estate space in your field?
So in the space, as far as real estate, I'll say about 10 years ago when I bought my first property, house hack that. As far as like a professional in the industry, about 5 years. So I spent 3 years as a loan officer, and then the rest as an underwriter for 2.
Okay. So walk us through, because currently, are you doing loans now?
Yeah. So currently, actually, I'm working on the underwriting side.
Okay.
Yeah, so that's what I'm doing right now. So basically, and that's kind of why I created the page. I think there's a lot of misconceptions out there as far as a lot of folks that are running around. You know, everybody wants to be I'm not a guru, but everybody wants to be a guru and say they know this and that. But very rarely do people know the actual guidelines behind what they heard, somebody else heard, they say. And so like when I look at like house hacking, like, you know, there's this concept running around that you can just run outside, buy a 4-family property, kick your feet up and live rent free. That's not how it works. There's guidelines behind it. I've never heard anyone ever mention the FHA Self-Sufficiency Test. I rarely hear anyone ever mention that when it comes to house hacking.
I got to interject, brother. Give it to us slowly, because we got to talk to the people in the back. What was that again?
Yeah, so when you're house hacking, so there's the FHA Self-Sufficiency Test. And so most folks have no idea what that is. And so what that says is if you're buying a 3 or 4 unit multifamily property with an FHA loan. So let me back up a little bit. So the great thing about using an FHA loan to purchase property is that you can buy a multi-unit property for 3.5% down. So whether that's a 1, 2, 3, or 4 unit property, I recommend not doing it with the 1 unit property. But if you're buying a 2, 3, or 4 unit property, 4 is the highest you can go. After 4 becomes a commercial property. Correct. You can put down 3.5% as far as the down payment, which is great, because if you're using any other type of loan type, you're going to put down maybe at a minimum 5, most likely like 10, 15, or 20%, which most people don't have to purchase the first property. But what a lot of folks don't realize is that there's this thing called the FHA Self-Sufficiency Test, and what it says basically is that your mortgage should be no more than 75% of the rent. So what that means is if you have 4 units in the property and they all rent for $4,000, so $1, $2, $3, $4,000 is the rent for the entire property. Your mortgage could be no more than $3,000, 75% of the rent for that property. And the reason behind that is because whenever you're going through the loan process, the lender assumes 75% vacancy. So that's another thing about purchasing real estate is your units are not always going to be occupied. So there's a 75% assumption of vacancy, which is why that regulation is in place. So you can make, not that you would have $1 million and live in an FHA property, but you can make $1 million. But if it doesn't pass that FHA self-sufficiency test, it doesn't work. You can do whatever you want, but if it doesn't pass that test, you're out of luck. So a lot of folks don't realize that that's a major part of that home buying process. And so if you don't realize that, your realtor doesn't realize that, you're going to be in trouble looking at properties that you can afford, but you can't qualify for.
Well, something you enlightened me all my years in real estate. I didn't know that. It's always a good tip. And now, is that across the board, literally throughout FHA, or does it apply only to first-time home buyers, own occupants, or?
Yeah. So just folks that don't know, the F in FHA stands for federal. So it's a federal program every state in the United States. So an FHA loan is only for a primary residence. So you have to live in the property for at least a year. There's certain, I wouldn't say ways around it, but there's certain things there's certain things if they come up, you can actually move out in less than a year for the FHA property. But yeah, when you're buying an FHA property, you have to be in that property for at least 1 year. You have to live there. Is the kind of the regulation there. So yeah, it applies to all FHA scenarios. All 3 and 4 unit multifamily FHA scenarios is where that guideline applies to.
So walk us through the underwriting process, right? You said that's your area of expertise. You get a book of loans that come across your desk. What are some, I don't know if you can reveal that, but what are some of the things that will stick out that would you say, this is a denial that people can prep for?
So I always say so let me start from the beginning. So I always say one thing is just be upfront is really the biggest thing where I see folks. So kind of just to walk you through the loan process. So step 1, either you probably got referred to a lender or you found a lender online. So step 1 is you applying online, putting your information and talking to the lender and getting like a pre-qualification or pre-approval. That's step 1. So it's kind of like, the saying garbage in, garbage out. So if you're not being straight up forward with your loan officer, they know the guidelines, but just not as good as an underwriter. Even the best loan officer doesn't know it is probably an above average underwriter. But so it's garbage in, garbage out. So if you're not upfront with them, like they're just going to do the pre-qualification based on what you told them. And then 2, you can get like a pre-qualification approval without submitting loan documents. But I always say you're fooling yourself. Like, it takes you, what does it take you, 5-10 minutes to download some W-2s and an income statement? So, why not turn those in? So you're kind of messed up, or you're not really serious if you're not turning in those documents. That's why when I was a loan officer, like I wouldn't even engage with that. Like if you can't spend 5 minutes to download some income docs and send them to me, like maybe I'm not the right person for you because you don't really seem that serious. And so getting to the loan process. So once you actually go under contract, you find a home, that's when it actually goes to the loan officer once you got that contract. So to jump into that part of the equation, that's why I say be honest up front with your loan officer. Because like I say, going back to the stuff on the internet, I see all this stuff on the internet, talking about, wipe your credit clean, do all this credit fixes and all that. That's great, but your underwriter is not just looking at your credit report. There's different programs that the underwriter is looking at, and I'm not going to stick with it. Y'all just I don't want to encourage people to try to do unsavory stuff. But just say like public records, you can't erase public records. Like you're not like Ethan Hunt, swiping down and
I know, right? Ethan Hunt.
Like just because you pay somebody $100 to wipe your credit clean does not mean that information is gone. I always say your lender is trying to lend you hundreds of thousands of dollars. Like you think some tip that somebody you paid $99 to is going to erase a bankruptcy, child support, these public records. That doesn't work. You can get stuff removed temporarily, but just think about it. Like Chase, Bank of America, Wells Fargo, they're $1 trillion companies.
Correct.
Like
correct.
This dude that you met on the internet that you gave some money to did not wipe stuff from their record. So like I said, just be honest, because one or two things will happen. Either you're just lying about something, or I'm going to say lying, but you're
misled,
or engaging in hyperbole about something.
Correct.
It really doesn't matter, and it makes you look bad. Or it's something that comes up and it's going to come up, and you've just wasted the last 3-4 months of your time looking for a house, or looking for a house when you couldn't qualify for the house. So the biggest thing is just be honest, because the underwriter will find it. Like I said, I look at files probably 3 or 4 times a day. Like I said, I look at stuff that homeowners, potentially like forgot. But like I said, public record, it's in like a court system. Like you're not.
Gotcha.
You're not getting rid of it. So no matter what you think, like it's still there. So
that's interesting you say that about, because you see it online so much. And again, I don't knock no one's hustle about how they make their money, as long as it's ethical and you're not breaking the law. But in terms of the the credit removal thing. Like you said, you made so much sense. These are $1 trillion companies, right? If they really want to dig deep enough, they can find kind of anything you got out there. Like you said, it's public information. And I was always curious, do they put it on hold or hide it, so this way when the score is pulled, it's not shown? I was always curious with that.
So what people do in order to get stuff removed from a credit report? So we all know Transperian, Equifax, Transperian, TransUnion, Equifax. I'm drawing a blank.
Equifax, TransUnion,
Equifax, and TransUnion. There we go.
TransUnion, there we go.
Those are the big three. So we have those big three. Then there's other companies that report to them because they don't have all your information. They just basically put it all in one spot. I can't think of the word for that. They all put it in one spot, but like they're getting information from like LexisNexis, Sage Stream. They're getting information from this bank check system. There's a bunch of different systems that they're getting information from, and so like those, like the LexisNexis of the world, they get the information. They'll get the information from like the courthouse. So like TransUnion is not talking to your local courthouse.
Correct.
But LexisNexis and other bureaus are talking to the courthouse, and then they're getting the information from like LexisNexis. So what people do is they'll send like I guess I'll just tell you how to get one removed. So what they'll do is you can send like a letter to your local courthouse and say, hey, if you have like a bankruptcy, and so you'll say, hey, do you report information to TransUnion about public records? And the courthouse is going to say, no, we don't. And they'll send you back a letter saying that, no, we don't. So then folks will send a letter to TransUnion and say, hey, there's a bankruptcy on my credit report. Please validate or verify that information. And then so TransUnion will send them a letter back saying, hey, we verified the information with the court system. But you already have that letter from the court system, so you know that they're not telling the truth.
Oh, wow. Okay.
They've actually got it from LexisNexis, not the court system. And then so you can send the letter back to TransUnion and say, hey, this is not accurate. Please remove from our credit report. So that's at a high level how stuff gets removed from the credit report. But here's the thing. The mortgage company is not just going to TransUnion. They're going to LexisNexis. And there's another one they go to as well, which I'm just not going to say.
Okay.
But there's another one that they go to as well, where most of the information is that, and that's the one that gets most of the people jammed up because it's still there. And also, what happens is, so even LexisNexis, it's not like you got it removed and they just throw up their hands like, oh, we're defeated. They're getting that information refreshed like every 2 or 3 months anyway. So okay, it got removed. Then LexisNexis is going back to the court system and just getting an information refreshed again. So that's why a lot of times when folks get stuff removed from their credit report, it pops back up for a couple of reasons. But public records will pop back up just because LexisNexis is going right back to the court systems just to get another update on the information because it's there. It's in the court system. So that's kind of how stuff pops kind of back up in your credit report. Is that stuff is never actually officially gone. Like I said, unless you're hacking into the core system and somehow deleting their records, which your guy you paid $99 obviously is not doing for $99. It's there and it'll be back. So basically, it's on temporarily freeze at the moment, but it's coming. Yeah. And so the other thing is if somebody does freeze something, that's great. You have privacy. It's your information. It's your data. You have the right to freeze stuff, but the lender has a right not to lend you stuff too. So if they're like, hey, I see your TransUnion is frozen, or I see your bank check system is frozen. Unfreeze it, or we're not going to give you the loan. That's how it works.
Okay.
So it's just like, you got it frozen, but the lender has the right to see your information in order to make that lending decision. So that's the other part. You can freeze stuff, but you can't get any funding when your stuff is frozen. So it's frozen, great, but
that information, like I said, I don't think I was not aware of any of that. And I'm glad you gave me insight on that. Quick commercial break. If you're interested in a career in real estate or you're a seasoned vet, you might want to change. New environment. You don't like the atmosphere you're in. The Headley Group Realty could be there to assist you with your career. What do we offer? Great culture, great environment, leads, and an awesome commission structure. Let us be there to support your business. One thing, you got to be in the state of North Carolina. Let's get back to the show. Walk us through a streamline, right? We see a lot of people with this whole with the moratoriums, people are starting to do a refinance. What is your thoughts on the streamline?
So thinking about like FHA streamline, it's good to me. If you have an FHA loan, to me, you just want to get out of the FHA loan to begin with, because a lot of FHA streamline is popular because you don't really need any proof of income or credit pull. They're just basically lowering your rate. But to me, if you're going to be in the home, and it's pretty quick, it can be done in like 14 days. But to me, if you're going to be in the home long term, you just want to get out of FHA loan to begin with, because like I said, FHA loans, for some reason they're super popular, or people think about them a lot. It's like, hey, I don't have a lot of money, let me think of an FHA loan. But one thing folks don't realize is an FHA loan actually has the highest minimum down payment of any loan type, which is 3.5%. There's NACA 0, there's USDA 0, there's VA 0, and there's conventional at 3.5%. So if you are in an FHA loan, like I said, the only reason I recommend FHA loans are, one, if you have credit issues, two, if you're purchasing that multifamily property. But to get back to your question, to me, you want to get out that FHA loan to begin with, is because an FHA loan has PMI, that mortgage insurance that stays in the loan forever for the life of the loan.
Can you let the people know what PMI is?
I always forget to say private mortgage insurance, PMI, private mortgage insurance. So basically, it's just insurance that you pay. So whenever you put down less than 20% on a loan, you pay insurance to the lender. So it protects the lender in case of a default. So let's say your mortgage payment is, I don't know, $1,500 a month. You may pay the lender, depending on what your credit is, you may pay the lender $150 a month. And it goes to the lender. It doesn't help you one bit. And it goes to the lender to protect them in case of default. Because in theory, I guess they don't actually do this, but in theory, they could, put it into a kitty or something like that. And it's like, okay, this person's made, 10 mortgage payments, 150 times 10. So now we have $1,500 in there just as a keepsafe, and we're collecting it every year as a keepsafe in case they default on the loan. So that's how mortgage insurance works. It just protects the lender, or it's just more money to the lender, or reinsurance to the lender in case you default on the loan for putting down less than 20% on the loan, because there's not enough equity in the home for the lender potentially to make back their money if you default potentially right away in the first couple of years. And so with a conventional loan, if you put down less than 20%, the mortgage insurance, what people don't realize is the mortgage insurance drops off at 78%. A lot of people think it's 80%, but it's actually 78% is where it drops off automatically. It's 80% at 80%, you have to reach out to the lender and actively ask them to drop the mortgage insurance. So they won't drop it at 80% unless you actually call them and say, hey, I'm at an 80% loan to value ratio. Please drop it off. They drop it off automatically at 78%. And so there's two ways to drop it off at the 80% threshold. One, so let's say your loan amount was $90,000. Let's say your loan amount was $90,000 and the property is worth $95,000. So if the property appreciates to $100,000 and you pay that $90,000 loan down to $80,000, now you're at that 20% loan to value ratio. And so you can get it dropped at that point, but you typically have to get an appraiser. You have to contact the appraiser or the mortgage company and say, hey, I'm at an 80% loan to value ratio. What can I do to drop this mortgage insurance? So you always want to ask them first, because they'll tell you one or two things. They'll tell you, one, it hasn't been soon enough. Sometimes if it's within the first 2 years, they don't care. Unless you made like a significant change to the property, like I've added a room or something like that. Or they'll tell you, hey, you can get an appraisal done, but you have to use the right appraiser. Or they'll just say, hey, you can contact a realtor and get a certified market assessment done. And if the realtor says the home's worth $100,000, we'll drop the PMI that way. But with an FHA loan, unless you put down 10% initially, which if you're putting down 10%, you're probably not using the FHA loan to begin with. But unless you're putting down 10% off the break, that PMI stays on the loan forever. So I mean, you can be paying that additional $100, $200, whatever the PMI is forever for the next 30 years. So I always say, if you can go from FHA to conventional to begin with. But back to the question, FHA streamline is basically if you made at least 6 months of mortgage payments on time, you can submit that, and you can basically get the interest rate reduced pretty quickly. So.
You know something, let me unpack that a little bit there, because you said something good in terms of refinancing out of that and dropping that PMI. So the bank won't call us or automatically drop it. We have to contact the lender to say, hey, I want to get this PMI dropped. Like, that has to be a physical phone call or email.
Yeah, correct. Only at 78% do they actually do it themselves, which could be another 2 or 3 years of you paying, the PMI. But at 78%, they'll do it automatically. But you're eligible at 80%, but they'll only do it automatically at 78%. You have to call them at 80%.
And then as soon as you immediately when that happens, refinance into a conventional loan.
Yes, correct. Yes, yeah.
Gotcha.
Or like I said, you can do it before. Always say, you can do it before if the numbers still work for you. So one thing I like to stress is that interest rates change day to day. So correct. A lot of times, like when I see folks saying, hey, I need to get this 700 credit score, 740 is a perfect credit score and apply for a mortgage. But I'll see folks saying, hey, I need to get this perfect credit score and I'm going to wait till I get this 740 or something to apply for a mortgage. That's because I want to get a better rate. That's fine. That's your prerogative to do whatever you want to do. But what folks don't realize is that, like, these interest rates change day to day. So like right. I looked at it earlier in the year, but there was one point, I think it was like in March, that when rates had popped up, I think it was like a 640, like in January or February, would have got you the exact same rate that a 740 in like March or April would have got. Because so rates are not just based on rates are based on your credit score, the loan size, the down payment amount, the term, the property type, but they're also based on stuff that's completely outside of your control. So they're based on the bond market, essentially, like mortgage-backed securities.
Correct. Okay.
Based on just the market, consumer confidence, and so basically like the benchmark rate of the Federal Reserve. So like if that moves, that's going to change your interest rate too. And so that's why I say, like, you can have a 640 today. 6 months from now, if you're waiting to improve your credit, that 740 potentially could get you a worse rate than that 640 could today, because no one can predict the future. Obviously, me, you, no one can predict the future. That's why I always tell folks, one, if the numbers work for you, pull the trigger. So if the numbers work for you today to get out of the FHA loan, even if you got to go conventional and still pay a little bit of PMI, do it, because who knows where rates will be a year from now, a month from now, 6 months from now. Like, there was a point early in the year where rates had moved almost like 0.5%. And for the worst in like a month time span. So my thing is, if the numbers work, execute. Don't wait for a certain threshold, whether it's that perfect credit score, whether it's 80% loan to value ratio. Just to me, get out that FHA loan as quickly as you can, if your plan is to keep that property long term. If you're going to keep it, if you're like, hey, I know I'm moving, or I know I have no plans to be a real estate investor, I know I'm probably going to sell this home in 3 or 4 years, that's when you probably want to just stay on the loan, because when you refinance, unless you're doing like the streamline, you're going to have to pay like closing costs. You may have to pay like $2,000-$3,000 to refinance. So you always want to weigh that $2,000-$3,000 it costs you to refinance versus how long it would take you to save that $3,000 in the monthly rate. So this is probably a bad example because you should be saving more to refinance. But let's say a refinance saved you $30 a month in your monthly payment, but you paid $3,000. So $3,000 divided by 30 is 100. So it would take you 100 months to basically to recoup that, which is, I don't know, 6, 7, 8 years. I don't know, something like that. It'll take you 8 years to recoup that. So hopefully you've gained a little bit more savings, or maybe like $100. So maybe it's now just 30 months it would take you to recoup that savings. So you always want to weigh the cost to refinance versus how long you actually be in the home, because your interest rate can go down, your payment can go down, and it still cannot make sense to refinance in some scenarios.
That is a great point there. I had a client actually had posed that question to me. I'm not in the mortgage industry, but we thought about that. Is it worth it to go through this process, spend extra money just to save a couple $100, right? Or to save $50. So, but that's a great point. Question here. The fact that rates are so low versus what it was 8, 9, 10 years ago, do you recommend a person stay in a fixed rate or an adjustable rate if it happens to come across, if the lender provided that option to them?
Yeah, so to me, I mean, rates are so low right now. To me, they're at a point where they can't get any lower, because at a certain point, like sorry.
That's all right. Take your time, brother. We okay. Take your time. You all right.
So there's a certain point where rates can't get any lower. So it's just like just lock in the rate now, because once again, I always say I can't predict the future, but a year from now, the rates. So a year from now, there's a couple feasible scenarios, like 3 feasible scenarios. Rates could possibly be like 1/8 of a point lower. They could be exactly the same, or more likely, they're going to be more than 1/8 of a point higher. Like if I had to put my money on the same 1/8 of a point lower or more than 1/8 of a point higher, I'd push all my chips on the table on 1/8 of a point higher thing. So it's just like the rates are so low right now, and they can't get any lower, because there's a point where the lender can't make any money.
Exactly.
Chase got to pay for the lease of the bank on the corner. They got to pay for their office. They got to pay for the processors. They got to pay. They have so much overhead. It's not like the Fed lowers the rates to 0 and they're going to give you a 1/4 of a point, interest rate. Like they can only get so low to it doesn't become profitable for the lender at a certain point. And to me, we're kind of at that point, because rates have kind of flatlined for the last year and a half. They haven't really gone under a certain amount, but at some point they're gonna jump back up. So to me, you want to lock in that low rate now. And just in general, in my opinion, like a fixed rate only makes sense, or excuse me, an adjustable rate only makes sense if somehow you know what your future is. Like if you know, hey, I'm going to move. I got a 5/1 arm, meaning that
correct.
The interest rate is locked for 5 years, and then after the 5th year, it's going to adjust every year. That's what a 5/1 arm is. I know that I'm going to be moving out of my home in 4 years, so I'm never going to have the arm adjust. To me, that's when it potentially makes sense. But I always say it's hard to predict the future. So we know we'd all be in a different business if we could. So.
Well, so man, I mean, you dropping so much good insight. Like I said, stuff I didn't know. Coins and culture. Let's dive into that. What made you say, I got to get out there, I got to just enlighten people? Like, what was that motivation? What drove you to say, let me get heavy on social media to give these people this valuable information?
Yeah, so it was in the middle of the beginning of the pandemic. So probably February, March, April of last year. I'm not sure why, because I hadn't posted on social media in like 3 or 4 years. And I was just like, hey, let me start this. Maybe sitting around board, I was like, hey, let me start this page. And it's funny. I would say to people, if you have an idea in your head, just start, because it's probably the same with you with the show. I don't know if it was, but it's probably the first.
No, it was. I just started. I said I want to make it happen. Let's do it.
Yeah, so
I have everything together. Let's go. Go ahead, though.
Yeah, so the first couple iterations, and you won't realize this until you get further in the line, the first couple iterations are going to be bad. They're just going to be bad. But you got to start and get better. So I'm not recommending anyone do this, but I think I have like 900 posts. But if you scroll all the way down to the bottom of my post, the graphics are horrible. I'm trying to be like the financial guru, and I'm trying to talk about all this investing and stuff like that. And one day I was just sitting around, I was like, I'm in the mortgage industry. Why am I not posting about mortgage stuff? That's kind of weird. And so I posted my first post. And so on average, I'd be getting like maybe 10, 20 likes a post. And I posted this mortgage thing. And I think because it was the authentic me. It was actually, it was talking about, people buying fancy cars, but they can't afford a home because they're in this fancy car. And so I've been like 10, 20, somewhere between 10 and 20 likes. And it got like 280 likes. I was like, I think I got something here. So I'm going to start posting.
I'm on to something.
Yeah. So I'm going to start posting stuff like maybe I'll do a mortgage tip Monday every day. And so I started posting, and the mortgage stuff would just get so many, more comments and engagement. People would DM me like, so I was like, okay, let me do this mortgage stuff. Like, let me do it 3 times a week. Cause I was posting every day. Let me do it 3 times a week. And then I was like, Man, I don't know if I can think of a mortgage topic every single day, but like when you're in the weeds and you love something, like you got unlimited, topics. So now I post like
Exactly.
three topics a day, and I got a list of probably like 100 things on reserve. But basically, the whole point of it, why I started going so heavy, was just I would just see a lot of misinformation out there.
And I figured that.
Yeah, and it's not my quote, but I think I've seen some iteration of it where it's like, there are people with half of your skill set, making twice the money you are posting on Instagram. So what's holding you back? And it's just like, if this person doesn't know what they're talking about is having success. Imagine if someone that actually knew what they were talking about started posting stuff. So there's just not a lot of stuff like it. I mean, when I think, honestly, I think of like, MG the mortgage guy. When I think of like mortgage stuff.
Right.
I like outside of like, and he doesn't really even post like specific guideline stuff a lot of times. But there's not really like a page that posts like mortgage stuff. So my thing was like, I want this to be like the number one resource on the internet for mortgage information, because there's not really like a source of mortgage stuff to go to. If you think like, hey, what's a page that talks about mortgage guidelines? I honestly can't think of a single one besides like my page that actually talks about the actual guidelines, and not like fluff for people dancing around and
bingo. Exactly.
So yeah. So that was kind of what.
Let me give a round of applause on that, brother. Because one is authentic. What I get from the page by me viewing it is authenticity and you being who you are, but it's actual facts, right? Yeah. So that's what gravitated me to you. Applaud you for that, brother.
Oh, thank you.
Hey guys, thank you for watching our show. We're gonna interrupt you real quickly. We are in the business of referrals. If you know someone looking to buy or sell, residential or commercial, here in the North Carolina area, refer us. We really appreciate that. Is there a question that I didn't ask you that you would like to answer?
Question that you asked me that I would like to answer. So I would say the thing I want people to know is that your interest rate does not matter. And so I say this because if you look at any mortgage commercial, any advertisement, the thing they advertise is the interest rate. The interest rate, it matters, but it doesn't matter. Folks are always like the interest rate is like the shiny object. The reason I say it is because as a loan officer, maybe 5% of the people I've talked to have ever asked me about the fees associated with the rate. But everyone's just so concerned about the interest rate. And so literally a loan officer can tell you any interest rate you want to hear, and they're right. Like it's not a lie. Like if you call me right now and say, hey, what are interest rates right now? I can tell you so interest rates right now are probably in like the low threes right now. And so if I was a shady individual, I would tell you I'd say 2.625. Because I know no one else is going to have a rate. Well, other people have a rate that low because they're going to use the same trick I'm using. But they'll say like a super low rate to get your attention and to get you attached to that shiny object. When in actuality, I always say a loan officer can tell you any interest rate you want to hear, and it's right because they can just buy down the rate to whatever level you want to. And so I always tell folks to focus on the fees before the interest rate, because you pay the fees at closing. Like, so if you're paying an extra $2,000 than you need to be, you're paying the $2,000 literally at closing. And for the difference of a quarter of a rate, so like a quarter of a rate on a 30-year loan is like a $6 difference in your monthly payment for every $100,000 the loan is. So if your loan is $200,000 and you got like a quarter lower rate, that's saving you $12 a month. And so, but if you're paying $2,000 to buy down that rate, like once again, doing the math, it doesn't really make sense to be so focused on the rate if you have no idea what the fees are associated with the rate. So that's one thing I always try to hammer home with folks. Your fees matter more than your interest rate, because you pay your fees at closing. They're called closing costs. You pay the interest rate over the life of the loan. So they're both important, but the fees are more important than the rate. If someone is focusing on a rate super hard and doesn't mention the fees, I would always be wary about that. Like when I would talk to my clients, I would always quote them the fee closest to zero and point that out to them, because a lot of folks don't. So,
some brother, literally, I say this with all honesty. you gave us so much information that a lot of lenders, right, never really, but again, your underwriter kind of revealed and opened up, because again, I got caught up in what's the rate? But you, as you said, the fees, you paying all this money just to save this much, and which is crazy. David, usually we ask people at the end of the show to give us 2 golden nuggets, right? Whether it was a book, a quote, a scripture, something that inspired you, so we can throw it out to our masters. What you got?
Oh, so 2
golden nuggets.
2 golden nuggets. So, oh man. So I would say one, just start. I don't know if that's a quote. Just do it. There goes.
No, I like that. I like that.
Just do it. So like I said, whatever. That's what I always say. We'll start in my page. Whatever you're doing, just start, because only 2 things are going to happen. You're gonna fail, and I'm doing air quotes for folks that are listening. You're going to fail. You're going to succeed. So if you fail, it's just you're learning a lesson. You're learning how to get better for the next step. But if you succeed, great. You probably won't succeed in the first time, but you're going to fail. So just start. Oh, so I actually got an actual quote for you. So in the military, one of the quotes that really stuck with me is that no decision is a decision. See, no decision is a decision to just stand pat and be fine with the circumstance. So a lot of people think that, I'm being wise while I'm thinking about the course of action, this and that. No, you made a decision to do nothing. So like in this is an extreme situation, but like in the military, like when something's happening, like you need to make a decision. I mean, sometimes it's better to make a bad decision than no decision, because at least you've taken some sort of action, and okay, that didn't work, so now I got more time to pivot. But if you make no decision for a long time and you sit around, then you make that bad decision, you got no time to recover. So yeah, no decision is a decision is a quote for you. That's my one quote. Do I got a second one? Sorry, I just got, maybe I'll think of something else, but that's kind of the one quote I got for you. No decision is a decision. So.
Well, you said just do it. And I think that, as simplistic as that sound, with Nike with the swoosh commercial, just do it, right? Yeah. We want to take our hat over to Mr. David Ball with Coins and Culture. You really enlightened us, and brother, you are a alumni to the show, right? And I would love to kind of have you on again.
Okay, sounds good.
We want to thank everybody for being a part of the Headley Group Real Estate Show, and we're having a great conversation with David Balls and Coins and Culture. We'll see you all next time.